Hi, I'm Lisa Gobro with Remax Pinnacle, and in today's video, I'm breaking down the most important home-related tax deductions that could save you thousands. Whether you just bought a home, made upgrades, or have been paying your mortgage for years, these tax breaks can put real money back in your pocket. So let's dive in. Home-related tax savings, the basics. Before we get into specific deductions, let's clarify two key terms: tax deduction versus tax credits. Deductions reduce your taxable income, which means you owe less in taxes overall. Tax credits provide a dollar for dollar reduction in the amount of tax you owe. They're much more valuable than tax deductions because they directly reduce your tax bill rather than just lowering your taxable income. Then there's itemized versus standardized deductions. You can only claim most home-related deductions if you itemize instead of taking the standard deduction. For 2025, the standard deduction is $15,000 for single filers and $30,000 for married couples filing jointly. If your total deductions exceed the standard amount, then itemizing is the better option. Then there's key home-related tax deductions and credits. Number one, mortgage interest deduction. If you itemize, you can deduct interest paid on up to $750,000 of mortgage debt. This applies to both primary and secondary homes, but not rental properties. Your lender will send you a 1098 with the total interest paid for the year. Then there's property deduction, property tax deduction, SALT cap rules. You can deduct up to $10,000 in combined state and local taxes, including property taxes, state income taxes, or sales tax, whichever is higher. And if you live in a high tax state, this cap might limit your deductions. Then number three is home equity loan and HELOC interest. Interest is only deductible if the loan was used for home renovations, a new addition, or other substantial home improvements. If you use the loan for debt consolidation, vacations, or non-home expenses, it's not deductible. Number four, energy efficient home improvement tax credit. You can claim 30% federal tax credit up to $3,200 per year for solar panels, energy efficient windows and doors, and upgraded HVAC systems. This is a credit, not a deduction, which means it directly lowers your tax bill, and that's good. Number five is capital gains exclusion on home sales. Selling your home, you might not owe capital gains if you lived in the home for at least 2 of the past 5 years, if your profit is under $250,000 for a single person, or $500,000 if you're married filing jointly. Big tip, keep detailed records of major home improvements. They can increase your cost basis and reduce your taxable profit. Number six is a home office deduction, self-employed only. If you're self-employed, you may qualify for a home office deduction if the space is exclusively used for business and if it's your primary place of business. So the two ways you calculate this, there's a simplified method, which is $5 per square foot up to 300 square feet, or the regular method, which is a prorated portion of rent, mortgage, utilities, and insurance. It's important to know that W-2 employees cannot claim this deduction under current state laws, tax laws, and it's not deductible. Number seven, home improvements and tax benefits. While most home improvements aren't immediately deductible, they can still impact your taxes. Major upgrades like kitchen remodels, roof replacements, and home additions increase your home's cost basis, thereby reducing potential capital gains when you go to sell. And as we mentioned, energy efficient upgrades like solar panels, efficient windows, and HVAC systems qualify for a 30% federal tax credit, up to $3,200 per year. And if improvements are medically necessary, such as a wheelchair ramp or a stair lift, they may be deductible as medical expenses. Lastly, if you take out a home equity loan or a HELOC, interest is only deductible if the funds were used for home improvements, not personal expense. So, the key to maximizing tax savings as a homeowner is good record keeping. Save all receipts for home improvements, mortgage interest, and property tax payments. And work with a tax professional to make sure you're getting every deduction you qualify for.